So, what if the stock market downturn we're all feeling right now is actually just the prelude to one of the biggest rebounds we've seen in years? Today, we're going to break down a really fascinating and honestly counterintuitive forecast that maps out a path right through today's economic storm and toward a massive recovery. So, right off the bat, here is the core prediction we're going to unpack. The source material lays out this really dramatic idea. Things are going to get worse before they get much, much better. Now, this isn't just some simple dip in recovery. Nope, it's a prediction of a fundamental economic shift. The big question, of course, is how? Okay, let's dive into it. First, we'll start with the prediction itself. Then we're going to unpack the perfect storm that's causing all the current trouble. After that, we'll look at the big pivot, tech's resilience, and then explore the AI engine that could power the comeback. And finally, we'll lay out the full roadmap to recovery. All right, section 1, the dip and skyrocket. And look, the forecast here is pretty blunt. Expect more market pressure for the next 6 to 12 months. This is the dip part of the equation, and it's being driven by a bunch of negative forces all hitting at once. But the key takeaway is that this is seen as the necessary runway for the skyrocket phase, a really powerful takeoff that comes right after. So what's causing all this short-term pain? Well, the analysis points to a perfect storm, 3 distinct economic pressures converging all at the same time. Let's dig in and break down exactly what those forces are. So this slide really boils that storm down to its 3 core parts. First, you've got an overheated market that just got way ahead of itself. In the middle, a crack in the financial system's foundation. And finally, a big dose of global uncertainty. Let's take a closer look at each one. First up, the overbought markets. For years, optimism, especially around tech, pushed stock valuations to these incredible heights, way beyond what the companies were actually earning. Now, with fears of stalling growth and inflation that just won't quit, those valuations are coming back down to earth in a pretty sharp, but you could argue, necessary correction. Now, the second force is a little less obvious, but it is just as important. Take a look at this massive number, $2 trillion. That's the size of the private credit market. Think of it like a parallel banking system for all those mid-sized businesses that aren't quite big enough for Wall Street. It is a vital engine for growth, and right now, that engine is showing signs of some serious stress. And this brings us to what the source is calling a quiet bank run. Now, this isn't like you see in old movies with people lining up outside a bank. This is all happening behind the scenes. Wealthy investors are getting nervous, and they're trying to pull their cash out. The problem is, that money is all tied up in long-term business loans, so the funds are having to slam the brakes and cap withdrawals. It is a major red flag for the health of this really critical part of our economy. And the final piece of this storm is geopolitical. The analysis we're explaining today points specifically to the US-backed conflict with Iran as a major wildcard. According to this view, it's messing with supply chains, spiking oil prices, and just eroding the investor confidence you need for a stable market. It adds this thick layer of unpredictability to everything. Okay, so that's the storm. Sounds pretty bleak, right? But every storm eventually breaks. And now we pivot from the problem to the solution. According to this analysis, there's one sector that isn't just going to weather this downturn, it's actually poised to lead us right out of it. And that brings us to the central question, right? If the markets are overbought, credit is getting tight, and global tensions are high, where on earth could a recovery possibly come from? Well, the answer, according to the source, lies in a fundamental shift in how one key industry operates. And this slide does a fantastic job of illustrating why this downturn is different. Over on the left, you've got your typical recession where pretty much all boats sink together. But the argument here on the right is that while tech got hit first and hardest, it's also perfectly positioned to be the rocket that pulls everyone else out of the water. It's not just a victim here, it's the potential hero of this whole recovery story. So how is that even possible? I mean, how can a sector that's laying off thousands of people be the engine for recovery? Well, the answer comes down to one single transformative technology: artificial intelligence. AI is completely changing the economic math for these companies. And here is the powerful 4-step cycle that makes it happen. First, companies start integrating AI deep into their operations. This leads to a massive leap in productivity. That, in turn, means higher profits, even with a smaller workforce. And what do higher profits always attract? A flood of new investment, which completes the cycle and fuels the big rebound. And look, this isn't just some abstract theory. To make it super concrete, check out this quote from the source. This is a real-world example of that productivity boom happening right now. When AI can write a huge chunk of a company's software code, it dramatically cuts down on development time and costs, and that directly boosts the bottom line. So we've got the problem defined, and we've got the engine for recovery identified. Let's put it all together. This final section lays out the predicted timeline, mapping the entire journey from the turmoil we're in today all the way to the new all-time highs projected for 2027. Okay, so this timeline gives us the predicted roadmap. Through the rest of 2026, the market is expected to stay pretty tough. The potential turning point, as you can see, is pegged for late 2026. And it all hinges on the Fed starting to cut rates and a stabilization of the conflict in Iran. That combination, well, that would set the stage for 2027, where capital is forecast to come rushing back into AI-powered tech and ignite that massive market surge. But here's the thing, and this is really important. This whole optimistic future isn't a guarantee. The entire recovery, as you can see here, basically rests on a bridge supported by two giant pillars. First, that geopolitical situation has to stabilize. And second, the productivity gains that AI promises have to become a widespread, tangible reality. If either of those pillars crumbles, the whole forecast is at risk. And that's really the final thought we'll leave you with. This all forecast bets heavily on AI as the hero. But is it a truly sustainable engine for long-term growth? Or is it more of a short-term productivity hack that just papers over deeper economic issues? The answer to that question is probably going to define the next decade.